Welcome back to Sin City Crypto. My name is David. I'll be your only co-host today, just like we did in the last live show, or the last FOMC meeting show. I'm going to be doing this from home. Why? Well, because we're going to listen to Jerome Powell talk for about 40 minutes. Now, the rate decision has officially come in, and to nobody's shock, including the CME, we did get a nothing. Sometimes they say less is more. Well, nothing is apparently more because the markets are rallying. And this article here from CNBC, Fed holds interest rates steady, still sees 2 cuts coming this year. Now, the importance is not going to be in looking at Bitcoin selling off just a little bit. Let's go to the super low time frame. Let's go to the 5-minute. You can see BTC is testing that 200-day moving average on the 5-minute time frame. Let's actually get rid of that because it's not as important on the 5-minute as it is on the rest. And so we're seeing a little bit of dumpage from BTC, which, why? Like, why? Everyone was expecting the markets to go, the Fed to do nothing. Now, although the Fed has done nothing, today is still a very important day. Why? The Fed's got the low CPI print. They got the increasing unemployment numbers. They have the GDP outlook for Q1, which is forecasted at minus 2.5 to 2.8%. They got the credit crunch. So this is all stuff we covered last week on the live show. These are all going to be factors into what Jerome Powell says. We also don't have, oh, here we go. So let's get into this. We'll take a look at what changed in the Fed statement. We'll share some pretty big news from Ripple, Solana, and then what the U.S. plans to do. And then right at, in about 25 minutes, as soon as Jerome Powell goes live, we will be covering that here on the show. So you get to listen to what Jerome Powell is saying. I'll be keeping my eye on the charts. I'll be taking notes. And then afterwards, we'll have a post discussion. We'll do a post-mortem on the price action. And we'll see if we find any opportunities to make some money with the charts, with the altcoins, or maybe even Bitcoin, maybe Ethereum. I know Ethereum is rallying the stock market. So we'll do that. It's going to be a fun, jam-packed show today. And this is going to be a 2 to 2.5 hour long show. So stick in here. We're going to have some fun. And I think I'm going to also do a giveaway. Don't know what, don't know how, but I like giving away stuff, especially when I'm here by myself, because I don't have to worry about no one, people giving me dirty looks. Oh, Robin. All jokes aside, let's get into this one here first. The Federal Reserve is in a closely watched decision. Wednesday held the line on benchmark interest rates, though still indicated that reductions are likely later in the year. Faced with pressing concerns over the impact tariffs will have on a slowing economy, the rate-setting FOMC kept its key borrowing rate targeted between 4.25 to 4.5%, where it has been since December. Markets had been pricing in virtually zero chance of a move at this week's 2-day policy meeting. Along with the decision, officials updated their rate and economic projections for this year and through 2027 and altered the pace at which they are reducing bond holdings. That's the other important thing. Letting stuff get off of the balance sheet, right? Letting it kind of expire and not putting it back on the balance sheet. I think that is going to end, providing more liquidity for the banks. So in this post-meeting statement, the FOMC noted an elevated level of ambiguity surrounding the current climate. There's a quote from the document: "Uncertainty around the economic outlook has increased. The committee is attentive to the risks to both sides of its dual mandate." Let's take a look. What has changed in the Fed statement? Now, obviously, you see in red what's been crossed out, what's not been crossed out. And so black text appears in both statements. And obviously the red is what's changed. What's been crossed out is what they got rid of. And if I can get this thing to get a little bigger. Come on, get bigger. Get bigger for me. Okay, it's not getting bigger for me. Anyways, so here is the entire statement from the Fed. Recent indicators suggest that economic activity has continued to expand at a solid pace. The unemployment rate has stabilized at a low level in recent months, and labor market conditions remain solid. Inflation remains somewhat elevated. Interesting, 2.8%. We know unemployment, we looked at a chart last week, it's actually going up. Jobs numbers came in lower what they thought. And with Doge and what they're doing with the federal government and the public employees, you're going to start seeing that unemployment rate continue to go up. All the growth essentially we saw in the Biden era, specifically the last 2 years, where we saw 800,000 jobs added, 400,000 a vast majority of that was the public sector, aka the federal government. And so when those cuts happen, the unemployment rate is going to go up. And if inflation continues to go down, I think that's the perfect storm for the Fed to come in and cut rates more than the two that they are saying. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run. Let me see if I can do this. There we go. In the long run. So originally it says the committee judges that, and it says uncertainty around the economic outlook is the committee is attentive to risks to both sides of its dual mandate. In support of its goals, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. And considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data. They say that every time. The evolving outlook and the balance of risks. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. Beginning in April, the committee will slow the pace of decline of its securities holding by reducing the monthly redemption cap on treasuries from 25 to 5 billion. That's a big number. What is that? A 70 or 80% reduction? An 80% reduction. So what does this mean? That means that they're essentially backstopping the Treasury Department, right? And so instead of reducing their monthly redemption by $25 billion, they're only reducing it by $5 billion, giving them a net of $20 billion. And so to me, this is a sign that they want to spur the equities, right? The equity markets, stocks, crypto, pretty much any risk on asset. The committee will maintain the monthly redemption cap on agency debt and mortgage-backed securities at $35 billion. I think that's going to change as well. As mortgage rates, they have been coming down, but we'll see. The committee is strongly committed to supporting maximum employment and returning inflation, yada, 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 and assessing the appropriate stance of monetary policy. The committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that can impede the attainment of the committee's goals, aka unemployment, aka inflation. The committee's assessments will take into account a wide range of information, including readings on the labor market conditions, inflation pressures and inflation expectations, and financial and international developments. Probably talking about the tariffs. And then that's how people voted. And we're taking a look. We were down, now we're up. And so you're seeing the volatility is pretty high right now on the markets. This is BTC on the 5-minute, on the 10-minute. And then if we take a look at maybe a little bit of a higher time frame, we had this bearish pennant that we kind of had our eye on that broke to the downside. And now we've officially re-entered into this pattern. And so there's a long way to go, at least on the shorter time frame, for this pattern to be invalidated. We want to be trading above 86,500. To me, that would mean that this pattern would be invalidated. If not, we could get, this could just be a deviation. We get back into this range. We test the top end of the range at around 85.5, and then we spill off down to the low 80s where we saw 81.5 be a very important level for BTC. On the 1 hour, you see we closed below and essentially had a V-shaped recovery. And then again, back into this pattern. We are seeing a lot of volume on the day. And so the rest of the markets, let me refresh CoinMarketCap. BTC up 3.9% on the 24-hour. ETH officially above $2,000. Shout out to ETH and all the ETH holders. BNB. So nothing big. Oh, XRP. And of course, we did an XRP video before I went live. And so after the live show, make sure to go watch that video. I covered in detail the SEC lawsuit being over, what that means, and how one niche, one narrative, one sector in crypto is now, those floodgates have opened to XRP. And we're talking 40, 50, 60, $100 trillion opportunity. How much of that market share can XRP get? I talk about that in the video. But since we're kind of on XRP, $2.50, I'm not going to play the whole video. Now, I did kind of react to this and play it in the morning one or in the upload, but just a quick kind of overview and listen to what Brad Garlinghouse's video was posted earlier today after the announcement that they're that they won. And so let me adjust my PC volume here, and here we go.
As many of you know, just over 4 years ago, the United States SEC filed its lawsuit against Ripple. I'm finally able to announce that this case has ended. It's over. Sitting here today and reflecting on 4 years ago, it seems very clear to me that this case was doomed from the start. In so many ways, it was the first major shot fired in the war on crypto. I truly felt like I knew then that Ripple was not only on the right side of the law, but I felt that we were also going to be proven to be on the right side of history.
It really, I think, sends an ominous sign for innovation around cryptocurrency in the United States. Picking winners in general has not been something the U.S. government should be in the business of doing.
I think the judge realizes this is not just about Ripple. This will have broader implications.
As Mary Jo White, the former head of the SEC, has said publicly that she views this as a dead wrong, and the SEC is dead wrong on this decision.
Ripple is the first company with the resources, determination, and grit to fight back against the agency's overreach. And today, this journey finally concludes. Today is a victory and a long overdue surrender by the SEC.
Now, the importance of this, too, to keep in mind is that the SEC dropped its appeal. So they're not trying to appeal the Judge Torres ruling anymore. Let me drop those. They're not trying to go after Judge Torres's ruling and appeal that. I know that's something Gary Gensler did on the way out. So thanks, Gary, but you lost. But now Ripple essentially becomes the plaintiff, not the defendant, because their lawsuit or their appeal against a $125 million fine, now it's up to them. Do they drop it? Do they continue to go after? I think they should continue to go after. $125 million is a lot of money. I know my co-host Robin, his kind of thesis is, hey, it kind of played out the way it is. Pay it. You got the money to do it. I say screw that. They dropped so many cases that are very, very similar to what XRP did. And if Torres ruled that, hey, it was not unconstitutional, but what they did with the institutional investors wasn't okay, then fine. Have them pay a fine. But $125 million to me is absolutely absurd. And so obviously XRP's price action was fairly positive today. We saw a massive candle on the 1 hour with tons of volume coming in. And then on the couple things I noticed on the daily for XRP, we kind of had this falling channel where we had one deviation above, and we officially broke out of that one. And on a 4 hour, on the lower time frame, we officially broke above our 200-day moving average ribbon on the 4 hour time frame. And so this is all positive. And if you zoom out again to the 1 hour, looks like we might be setting up for a really nice bull flag pattern, which will break to the upside. And that measured move, and it's funny, the entirety of the pole is one candle. Depending on where we break, and you know what, we can draw some fibs here, or we can throw a fib on here. And so we'll draw the fib from this candle here. And so to me, an invalidation is anything below 50%, which would be around $2.46. So assuming the breakout comes there, you're looking at an XRP price of around $2.74, which is around our box here, which is around, I think, $2.78, where we expect XRP to meet some resistance. But this is a pretty nice setup on the lower time frame. And again, some bullish momentum for XRP. But the most important thing here is momentum with volume, okay? And I know the two are kind of synonymous. You can't really have momentum with volume. But if you want to figure out, was this a fake move? Was this a real move? There's real volume behind this move. And so people are excited for XRP, as they should be. It's been 4 long years. And so I think the floodgates are about to open. And again, go watch that XRP video I posted earlier today after today's live show, and you'll kind of get an insight into what I think is going to happen. And then we had another piece of big news here. The first Solana ETF to launch in the US tomorrow. Now, the important thing here, it's not a spot ETF, it's the futures, right, with the CME. And so with Bitcoin and ETH, that was kind of the playbook. The process, so to say, is you get a futures that trades for a year and a half, 2-3 years. Gary Gensler wanted like 4 or 5 years. But the whole idea is to see how good that they track the actual price of the asset, and then the spot gets approved or got approved. Bitcoins was on there for years. Same with Ethereum, but they've so far been the only two. Now you can add Solana to the list. And so it makes sense to think that, okay, Solana now, we can say we'll get the first spot. Now remember what Mark Yusko talked about on our show yesterday, and what we saw with Bitcoin and what we're seeing right now with Ethereum, what he said, when you get commodities or on the futures markets, they're easily manipulated, and that's what they do. They long the futures and short the spot, and they arbitrage their way that way. They don't give a shit about the project going up 30%, 40%. The utility is great. It's got this many daily active wallets and transactions. They don't care. They want to make money, whether it's 2%, 5%, 10%. It doesn't matter. And so if they can find a 2% edge in an arbitrage situation, they're going to do it. And so that's one thing to keep in mind. Now, the biggest hindrance to the Bitcoin one was Grayscale, the amount they were holding and redemptions that happened because their fees were so high. I don't think we're going to see something similar with Grayscale now. There's way less in the Grayscale Solana ETF or Grayscale Solana Trust versus the Grayscale Bitcoin and the Grayscale Ethereum Trust. But again, Wall Street now will have another tool to exploit the inefficiencies in crypto. And that's how Sam Bankman-Fried made his money. And so we'll see how this plays out. But either way, this is a step in the right direction. Again, now no one will have an excuse if you believe in Solana. And I'm not talking about us here in the crypto space, but the people outside the crypto space, your friends, your families, people on Wall Street. You can just say, hey, you're bullish on Solana, but you're technologically unsavvy. Just buy the ETF and hold it, and the price will appreciate. And then we have this as well. This is posted by Altcoin Daily. This is Bo Hines. I forget his exact title, but I think he's like a digital asset advisor to President Trump. Either way, he was on CoinDesk, and let's take a listen to what he had to say.
The U.S. has already acquired about 200,000 BTC. That's worth about $17 billion. Strategy CEO Michael Saylor is suggesting that the U.S. acquire up to 25% of the Bitcoin supply by 2035. What would be the target amount for the United States in your view?
Well, I get asked this question a lot, and I think the answer to that, like I said at the summit yesterday, is as much as we can possibly get, so long as it's in budget neutral ways that don't cost the taxpayer a dime. I think we have a lot of high.
All right, this guy obviously has been talking to Michael Saylor. When someone asks you how much, as much as we can get, and remember, this is the gentleman who's on the Presidential Council of Advisors for Digital Assets. And he's, I think, the number one voice in Trump's head. And he's out here saying, we want to buy as much as possible. And your neighbor down the street has convinced you that Bitcoin is going to zero. Keep that in mind.
IQ people in the building that are working on this, and folks over at the Treasury office and folks over at Commerce, working with the internal working group that was set up in the first digital assets EO, we'll be able to come up with ways to accumulate more really over the course of the next few years and beyond that. I mean, look, we view Bitcoin as being digital gold. That's why we set up the strategic Bitcoin reserve in the way that we did, right? Bitcoin is a commodity. It's not a security. As our AI and cryptos are, David Sachs likes to say, it has the immaculate conception, meaning that there's no issuer. It has intrinsic stored value that's traditionally accepted. And we feel like it's in the best interest of Americans to hold on to this asset long term and accumulate as much as we can get. That's why we've akin this to digital gold and talked about building the digital Fort Knox for the United States. And, you mentioned the Bitcoin that we have possession of. We've actually been in possession of nearly 400,000 Bitcoin. We sold roughly half of that prematurely at about, I think it was close to $370 million is what we sold it for. If we would have held on to that, it would have been worth $17 billion today. I mean, it just goes to show you how important this asset is and what we can do with it to benefit the American people. One thing that I've said repeatedly throughout the media circuit is that I think it's really nice that we have a president that's actually looking to accumulate assets for Americans rather than take it away, unlike the last regime that we had here at the White House. But we feel very confident about our plan. We feel confident about the internal working group that was set up in that first EO. And I think we're going to have tremendous ideas on how to accomplish this.
So let me ask you a question. How could you watch that and be bearish on Bitcoin or crypto, right? How is that even possible? You got the number one advisor to the president talking about, we want to buy as much as possible. Now, to be fair, from my perspective, we need to get actual legislation, right? You can do the budget neutral ways. That's all great. It's a great start. We're not going to sell our Bitcoin. I think that in alone is an absolutely great start. But if you want like actual staying power with what you want, and not to have another president come in and completely rescind the executive order. And all of a sudden, we're in the next bull market with a new president. And it's not a pro crypto person, or maybe they're just kind of indifferent to Bitcoin and crypto and like, yeah, it's worth like $40 billion. We could probably sell that and do X, Y, and Z with it. And so that's one thing to keep in mind. And so for me, I want to see legislation. I want to see the House of Representatives allocate some sort of money to buying Bitcoin. The budget neutral way idea is great, but I want something that's going to be long lasting. And so either way, though, absolutely great news. I'm just going to take a peek at the chat, welcome some people. If you guys have been watching our show for a while, you know this is not our normal setup. But again, due to the fact that we're just going to be covering Jerome Powell, and what we're doing right now is we're kind of covering some of the hottest topics of the day until he goes live, and that goes about 5 minutes. But once he goes live, pay attention to the questions that are asked and pay attention to what he says. We're going to look for cues such as is his tone changing? What can we potentially expect in the next meeting, which I believe is in May, the beginning of May, I think May 6th. So we'll be looking at those, and I'm sure you'll get a lot of questions about the balance sheet. That's going to be important. I'll be taking notes here. We'll be watching it together, and then afterwards we'll come back. We'll take a look at price action. Did the markets like it? Did the markets not like it? Are there any opportunities? And then we'll kind of do a post-mortem on that. And so we'll keep you guys up to date on everything you need to know for the macro for today. Miguel Costa, Dixie Flatline, Crypto Hands, Decrypto, Ada BB, Vinny Del Greco. Welcome, Vinny. Muhammad. Wow, he likes ETH, Tau, and ICP, and Polkadot, I guess. Okay. Who are you, and where is the real Muhammad? Because I don't see enough zeros in there. Also, Eugene said, cut them rates. Yeah. We knew it wasn't going to happen, though, right? We knew it was not going to happen. The CME was 99%. The betting markets were 99%. And so, but again, the important thing is going to be what he says today. But I think the more important thing is going to be the FOMC minutes that comes out in about 2 to 3 weeks, where they have an entire transcript of what was talked about, what was said, all that fun stuff. And so I'm keeping my eye. This is what I got open here. He has not gone live yet. And so if you're looking for the press conference live, it has not started. And again, we'll be covering that on the channel today. Let's take a look at some of the other big gainers of the day. EOS, God, the largest ICO ever. And this is what their chart looks like. They rebranded. And if I'm correct, they rebranded. What did they rebrand to? I forget the name, what they rebranded. Either Volta. They rebranded to Volta, and so it's up. I don't know why people are bullish on it, but yeah, they raised a lot of money, and it's essentially was just the project died. Uniswap up 12.5%. Looks like the Ethereum ecosystem is rallying. You have ENS, Uniswap, and Lido. 3 out of the top 4 gainers of the day. And then, of course, XRP, as we already went over. Hyperliquid Near Protocol showing a little bit of life here, up 10% on the 24-hour, currently sitting at $2.75. I want to take a peek at the stock market. Let's take a look at so the VIX is down. This is good. Let's look at the Dow Jones. That is up 0.5%, which is also good. Price action, we can go to the lower time frame. Let's go to the 5-minute chart here. Got a nice bounce off of the MA ribbon here, which is good, and setting up for a potential bull flag pattern here. Even though the markets are, as you can see here on the 5-minute candle, we can even go to a 1-minute candle. Let's go 1-minute candle for the Dow Jones. You can see it is currently dropping, and then the Nasdaq as well. This is the one that's more correlated to risk on assets and crypto specifically. This is what that daily candle looks like. It's actually a fairly nice daily candle for the NASDAQ, but we're still kind of in this potential bear flag pattern here for the NASDAQ that eventually, I believe, will break to the downside, but a little bit of relief in the markets today. We can go down to the 4-hour, kind of range bound between this level here, but that's 17,300 and around 17,800. So you're seeing a little bit of volatility in the markets today, and at least in the Nasdaq, and down on the 1-hour, again, kind of chopping sideways. We had a couple of gaps here, one gap up, one gap down, And the gap, obviously, to the upside has filled to the downside. And then we expect to see some. So if you're trading in the macro, that's what to look for. But for me, obviously, we're a crypto channel. We're not a macro channel. What I pay attention to for the NASDAQ is the higher time frames. And this shows that it is still bearish. And so again, I'll refresh this page. We are still waiting for Fed Chair Jerome Powell to make his way to the stage. But again, just wanted to come in here a little early, talk about the Fed, their statement, what changed, and how the markets have reacted. And so let's take a peek at a Bitcoin chart while we wait. So BTC kind of hovering around that 84.3 region, which 84, we did recently flip that to resistance, which was not good. And obviously now we're trading above. But this was support for a little bit of time. This is on the 1 hour time frame. We spilled off and we failed multiple retests. But again, we are still currently within our bear pennant pattern here. We're trading above the 200 MA ribbon. And so, oh, there we go. All right. Let's listen to Jerome Powell. I might chime in from time to time, but this is all going to be what he's saying. I'll keep my eye on the markets. If anything dramatic happens or he says something, we can pause, cut away, take a look at the charts. But for the time being, my plan is to just listen to what he has to say, hear how he answers the questions, pick up on some tone changes, and here we go.
Remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. As we parse the incoming information, we're focused on separating the signal from the noise as the outlook evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year, unchanged from December. While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets. Beginning in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we are leaving the cap on agency securities unchanged. This action has no implications for our intended stance of monetary policy and should not affect the size of our balance sheet over the medium term. The committee also continued its discussions as part of our 5-year review of our monetary policy framework. At this meeting, we focused on labor market dynamics and our maximum employment goal. As we have indicated, our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Howard Schneider with Reuters. Thanks for your time. So 2 things on sort of the real side here, inflation and then GDP. How much of the higher inflation forecast for this year is due to tariffs? And since the policy path remains the same, are you effectively reading this as a one-time price level shock?
Okay, so how much of it is tariff? So let me say that it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it. A good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation. In terms of your sort of looking through question, too soon to say about that. As I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and would depend critically as well on inflation expectations being well anchored, longer term inflation expectations being well anchored.
Well, I guess I'm looking at the out years here, and the fact that the policy path doesn't change at all, and inflation is unchanged in the out years also. Doesn't that imply you all have basically decided that there is no signal here, and that it's just we're back to transitory again?
So I think that's kind of the base case, but as I said, we really can't know that. We're going to have to see how things actually work out. And the fact that there wasn't much change, I think that's partly because you see weaker growth but higher inflation. They kind of offset, and also, frankly, a little bit of inertia when it comes to changing something in this highly uncertain environment. I think there is a level of inertia where you just say, maybe I'll stay where I am.
Thank you. Colby Smith with the New York Times. You just described inflation expectations as well anchored, but has your confidence in that assessment changed at all, given the increase in certain measures and the high degree of uncertainty expressed by businesses, households, and forecasters?
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully, basically every source we can find, and short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this. You do see increases widely in short-term inflation expectations, and people who fill out surveys and answer questionnaires are pointing to tariffs about that. If you look in the survey world, if you look a little further out, you really don't see much in the way of an increase. Longer-term inflation expectations are mostly well anchored. If you look at the New York, for example. Then you have market-based, and it's the same pattern. People in markets are pricing in break-evens. Some higher inflation over the next year must be related to tariffs. We know from the surveys. But if you look out 5 years or the 5-year forward, you'll see that break-evens are either flat or actually slightly down in the case of the longer-term one. So we look at that, and we will be watching all of it very, very carefully. We do not take anything for granted. It's at the very heart of our framework, anchored inflation expectations, but that's what you see right now.
And how much weight do you put on the deterioration in consumer confidence surveys? You said recently that this is perhaps not the best indication of future spending, but I'm curious, what you think is behind this deterioration, and to what extent it could be a leading indicator for hard data.
So let's start with the hard data. We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show significant rise in uncertainty and significant concerns about downside risks. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know that will be the case here. We will be watching very carefully for signs of weakness in the real data. Of course we will. But, given where we are, we think our policy's in a good place to react to what comes, and we think that the right thing to do is to wait here for greater clarity about what the economy is doing.
Nick Timmeros, The Wall Street Journal. Chair Powell, Chair Greenspan once defined price stability as an environment in which inflation is so low and stable over time that it doesn't materially enter into the decisions of households and firms. Can you say that today, that we have that price stability, that households and businesses are ignoring price growth when you see buy in advance psychology, big changes in inventories, and surveys that show consumers, at least in the short run, expect higher inflation?
So I do like that definition a lot. In fact, I used it at the recent conference where I spoke. So I think a world where people can make their daily economic decisions in businesses and they're not having to think about the possibility of significantly high inflation. We know inflation will bounce around. That is price stability. You know, I think we were getting closer and closer to that. I wouldn't say we were at that. Inflation was running around 2.5% for some time. I do think with the arrival of the tariff inflation, further progress may be delayed. The SEP doesn't really show further downward progress on inflation this year, and that's really due to the tariffs coming in. So delayed, but if you look at our forecasts, we do see ourselves getting back into the low twos in 26 and then down to 2 by 27, of course, highly uncertain. So I see progress having been made toward that, and then progress in the future. I think that progress is probably delayed for the time being.
If that's the case, why are there cuts in the SEP for 2025?
So again, people wrote down 2 cuts the last time, and they look at they wrote down meaningful decline in growth from 2.1 to 1.7 in 2025, a tick up in the unemployment rate, so not much there, but core inflation up by 0.3, and so those kind of balance each other out. So people, not everybody, but on balance, people wrote down similar numbers. The changes aren't that big. The other factor, though, as I mentioned, is just really high uncertainty. What would you write down? I mean, it's really hard to know how this is going to work out. And again, we think our policy is in a good place. We think it's a good place where we can move in the direction where we need to. But in the meantime, it's really appropriate to wait for further clarity. And of course, the costs of doing that, given that the economy is still solid, are very low.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So with near 4% unemployment rate, that should be low enough to bring people in from the sidelines in terms of hiring. But we're seeing the hiring rates have been stuck at 2023, 2024 levels. So what's going on there?
Yeah, so that's a feature has been for some time a feature of this labor market. You have pretty high participation accounting for aging. You've got wages that are consistent with 2% inflation, assuming that we're going to keep getting relatively high productivity. We've got unemployment, pretty close to its natural level. But the hiring rate is quite low, but so is the layoff rate. So you look at initial claims or layoffs, so you're not seeing people losing their jobs, but you're seeing that people who don't have a job having to wait longer and longer. And, the question is, which way does that break? If we were to see a meaningful increase in layoffs, then that would probably translate fairly quickly into unemployment because people are, it's not a big hiring market. We've been watching that, and it's just not in the data. It hasn't happened. What we've had is a low firing, low hiring situation, and it seems to be in balance now for the last 6, 7, 8 months. That's where we are. There's healthy levels of job creation too. So overall, it's a labor market that's in balance, and we watch it very carefully.
So then, have we seen the new administration's policies in the economic numbers yet? And when do you anticipate that happening?
In labor or in other?
In labor and inflation, just across the economy, have we started to see the new policies take effect in the numbers?
Only in a kind of an early way. I mean, it's only been a few months, right? For example, the layoffs that are happening here are, they're certainly meaningful to the people involved, and they may be meaningful to a particular neighborhood or region or area, but at the national level, they're not significant yet. But we don't know. We don't know how far that will go. We'll find out much more. I mentioned that you saw we've had two very strong goods inflation readings in the last 2 months, which is very unexpected. I think hard to trace it to specific tariffs, but it must have something to do with, it's either noise and it'll come back, and that's very possible too. But if it is persistent, then it must be to do with people buying ahead of tariffs or raising prices ahead of tariffs and things like that. Those kinds of things happen, and they're very, very hard to capture because so much of it is indirect. A great example is their washing machines were tariffed in the last round of tariffs, and prices went up. But prices also went up on dryers, which were not tariffed. So the manufacturers they just kind of followed the crowd and raised it. So things happen very indirectly. And so there'll be a lot of work done in coming months to try to trace all that through. But ultimately, though, it's too soon to be seeing significant effects in economic data.
Craig Torres from Bloomberg News. Thanks, Chair Powell. You said transitory price increases from tariffs are the base case. Transitory is the base case. Wasn't it the base case last time? And didn't the FOMC forecast lower inflation ahead last time? And wasn't the lesson that it quickly got into services, haircuts, daycare, everything else? And so I'm just wondering why the 9 aren't taking that on board and are cutting twice this year.
When you say last time, are you talking about the last
pandemic? Yes, during the
because
pandemic.
you could have been talking about the last time there were tariffs, in which case the inflation was transitory. Yeah, no, of course we're well aware of that, and it's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy, because by the time you have your effect, you're in effect by design, you are lowering economic activity and employment. And if that's not necessary, you don't want to do it. In real time, as we know, it's hard to make that judgment. And we're well aware, of what happened, obviously, with the pandemic inflation. But I mean, we have to look at this as a different situation. There are differences and similarities. I mean, it's a different time. We haven't had real price stability fully reestablished yet, and we have to keep that in mind. And we hear that people are very reluctant to take on to allow prices to go up. At the same time, we hear that businesses are intending to pass many of these prices through. So it's hard to say how this is going to work out.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. The Bank of Canada, in its last policy statement, said monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. I wonder if that kind of reflects your own sense of prioritization faced with higher prices and weaker growth, that the idea is you have to take care of inflation.
So we have two goals, right? We have maximum employment and price stability, and we have to balance those. And, there can be situations in which they're in tension, right? And we actually have a provision in our consensus statement that says what we should do in that case. That's a very challenging situation for any central bank, and certainly for us. And so what we say that we'll do is we'll look how far each of those two goals is, each of those two measures is from its goal, and then we'll ask how long we think it might take to get back to the goal for each of them, and we'll make a judgment, because our tools work in one direction. We're either tightening or loosening. So it's a very challenging situation. Let me say, we don't have that situation right now. That's not where the economy is at all. It's also not where the forecast is. I don't know any mainstream forecast that really shows significant problems like that.
Well, just to follow up, yesterday the UCLA Anderson forecast said there's high probability of a recession. Where do you stand on whether or not the slowdown you're seeing creates a higher probability or concern that you may have on recession? Thank you.
There's always an unconditional possibility of a recession. It might be broadly in the range of 1 in 4 at any time. If you look back through the years, there could be within 12 months a 1 in 4 chance of a recession. So the question is whether this current situation, those possibilities are elevated. I will say this: we don't make such a forecast. If you look at outside forecasts, forecasters have generally raised, a number of them have raised their possibility of a recession somewhat, but still at relatively moderate levels, still in the region of the traditional, because they were extremely low. If you go back 2 months, people were saying that the likelihood of a recession was extremely low. So has moved up, but it's not high.
Hi, thank you. Chris Rugaber at Associated Press. As you know, I guess last night, President Trump fired 2 members of the Federal Trade Commission, an independent agency, and this could cause the kind of legal fight about the administration's power to fire independent people. If those firings stand, is that a threat to the Fed's independence? Could he do the same thing to the Fed board?
So I think I did answer that question in this very room some time ago, and I no desire to change that answer and have nothing new for you on that today.
Well, maybe I have another mulligan. As you know, I wanted to go back to the consumer sentiment, particularly the inflation expectations in the University of Michigan survey. In the summer of 2022, you cited the rise in the long-term inflation expectations in that index as the reason that you went big with a 3/4 point hike. So I know you've talked about all the different measures now, but you seem to not be placing the same weight on that. And so I'm just wondering, are you dismissing that, what we saw last week from the University of Michigan, or does that carry the same weight as it did in the past?
So I mentioned it back then, but in no way did I place a huge weight on it. I think that was a ex post story, but it wasn't the case. That was a preliminary reading, and so is this. And it's also, this is that Michigan, the one you're referring to, the longer term thing. You know, we look at it, we don't dismiss data that we don't like, we force ourselves to look at it, but it is an outlier compared to market-based and compared to other survey-based assessments of longer run inflation expectations. So we got to keep that in mind. And I would just say we look at all of them, and that one's kind of an outlier, but nonetheless we take notice of it.
Michael McKee from Bloomberg Radio and Television. There's a worry on Wall Street that when you say you want to study the net effect of the fiscal policies we may see on the economy, that you would end up waiting too long and be behind the curve in responding to any downturn. How can you reassure people that you can spot a problem early enough unless you decide to be preemptive?
Yeah, look, we're aware of we're well aware of how things are going to evolve and the time frames and all that. And we will use our tools to foster achievement of our goals to the best we can. And of course, we're going to try to be timely with that. For right now, the hard data are pretty solid. We are obviously aware of the soft sentiment data and high uncertainty, and we're watching that carefully. And we think it's a good time for us to wait for further clarity before we consider adjusting our policy stance.
Do you think it's going to be hard to get clarity in a government by tweet? I mean, do you have a feeling that at some point you actually will have a forecast you can trust?
Yes, I think we will. It's hard to say when that will be. These decisions are going to be made and they're going to be implemented, and then we'll know. At that point, we'll know what the decisions are, and we'll have to make assessments then about the implications for the economy. Those things will happen. A lot of them will happen over the course of, in coming months, certainly over the course of this year, and we'll be adapting as we go.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. At the beginning, you were talking about separating the signal from the noise and tariff inflation from non-tariff inflation. Can you walk us through what that looked like over the last couple of months, if there were specifics from the January meeting to now that helped you make those distinctions?
So when we say separating the signal from the noise, that's just a way of saying that things are highly uncertain and that, you're reading about developments. The news is full of developments of tariffs being put on and taken off and things like that. Some of that is noise in the sense that it's not really telling you anything. You're trying to extract a signal from that, and the signal is what's going to be the effect on economic activity, on inflation, on employment, and all those things. So that's really when we say signal and noise. Sorry, the second thing was?
Or similarly for tariff inflation, non-tariff inflation, ways that you're making the distinction.
That's sort of a special case of that. The idea being, and I do think that the first 2 months of this year are a great example. You've got high readings for goods inflation after a string of readings that average close to zero, and you have to ask, it's coming during tariffs, but you can't. It's very hard to actually scientifically go back and match up those increases and say, yes, I can prove that that's from tariffs, but it kind of has to be to some extent. Plus noise. There can be idiosyncratic readings in various categories, which will shortly reverse, and that happens too, and that could be a big piece of it. I think we'll know in a couple of months. We'll know whether those were, where that really was from. But that's another case where I think it's going to be very, very challenging to unpack the inflation that we see over the course of this year and be able to say with confidence how much of that came from inflation and how much of it, from tariffs and how much of it didn't. But that's what we'll be doing. We'll be doing that, and so will everybody else, and we'll all be trying very hard to make that assessment. And, I'm sure we will make a lot of progress on that, and we already have. But it's going to be a challenge.
Do you have a sense yet as to what, in your mind, would make something cross from noise to a signal, what that threshold would look like?
It would depend on what we're talking about. I mean, obviously, you're looking for direct evidence that particular pieces of inflation are or are clearly not caused by tariffs. For example, if it's something that was, in the service sector that was far away from anything that's tariffed, you might think, okay, well, that is, like, frankly, housing services inflation, which, by the way, has been behaving well, which for some time was kind of our problem. Now it's slow, but it's definitely, moving down in a very good way. It's more now with goods and to some extent with non-housing services inflation.
Thanks for taking our questions, Chair Powell. Kelly O'Grady, CBS News. So consumer sentiment has dipped dramatically, but you say the economy and the hard data is still solid. What is your message to consumers that clearly disagree and don't feel that strength? Because the hard data they're looking at is their grocery bill.
Okay, so a couple things. The grocery bill is about past inflation, really. There was inflation in 21, 2, and 3, and prices went up. The current level, it's not the change in prices. It's they're unhappy, and they're not wrong to be unhappy that prices went up quite a bit, and they're paying a lot for those things. So I think that is the fundamental fact, and has been for a long time, a couple of years, why people are unhappy with the economy. It's not that the economy is not growing. It's not that inflation is really high. It's not that unemployment is high. It's none of those things. We have 4.1% unemployment. We've got 2% growth. And, it's a pretty good economy, but people are unhappy because of the price level. And we completely understand and accept that.
And just to follow up, why are you still projecting 2 rate cuts this year if your own projections show inflation higher for longer? Does that mean you see a slowdown in economic growth as a real threat?
So I think remember we came into this with, at the December meeting, the median was 2 cuts. The median was. And so you come in and you see, broadly speaking, weaker growth but higher inflation. And they kind of balance each other out. So you think, and unemployment is there's really only a 1/10 change. So there's just not a big change in the forecast. There really isn't. Modest, meaningfully higher growth and meaningfully higher inflation, which call for different responses, right? So they cancel each other out, and people just said, okay, I'm going to stay here. But the second factor is it's so highly uncertain. It is just, we're sitting here thinking, and we obviously are in touch with businesses and households all over the country. We have an extraordinary network of contacts that come in through the reserve banks and put in the beige book, and also through contacts at the board. And we get all that, and we do understand that sentiment has fallen off pretty sharply, but economic activity has not yet. And so we're watching carefully. So I would tell people that the economy seems to be healthy. We understand that sentiment is quite negative at this time, and that probably has to do with turmoil at the beginning of an administration that's making big changes in areas of policy, and that's probably part of it. I do think the underlying unhappiness people have about the economy, though, is more about the price level.
Hi, Victoria Guido with Politico. I wanted to ask, first of all, if you could clarify. You were talking about how tariffs were a good part of the uptick in the inflation forecast, and I was just wondering what that specifically refers to. Is that the tariffs that have already been put in place? Is that anticipating some of the tariffs that might be coming on April 2nd? And then also, if you wouldn't mind, talking a little more about the balance sheet decision and what drove that. Did that have anything to do with expectations of how the debt ceiling, raising the debt ceiling, might affect the reserve supply?
Yeah. So in the SEP, you'll see that there's not further progress on core inflation this year. We're kind of flatlining, going sideways. We don't ask people to write down how much of this is from tariffs and how much of it is not. But some of it is from tariffs. We know that tariffs are coming in. We know that they're probably already, all forecasters have tariff inflation affecting core PCE inflation, core CPI inflation this year, without exception. I'm not aware of an exception. So it's in there. I can't tell you how much of that it is. In terms of the balance sheet, so yeah, I think, I guess the way I'd say it is, it was the flows in and out of the TGA that got us thinking about it. But as we thought about it, we really came to the view that this was a good time to make the move that we made. And broadly, committee that came around to the view that we would do the same thing we'd already done, which is I guess in June, was it June? Whenever it was, we lowered the pace of QT, and we're just going to do that again. We're going to cut it roughly in half. And the sense of that is, if you're cutting the pace of QT roughly in half, then the runway is probably doubled. Okay, so it's going to be slower for longer. And people really like that. People thought that's a good idea. It's like a plane. You can think of it like a plane coming in for a landing. As we get closer, and we by the way, we still think that reserves are abundant, although you begin to see some of the things we look at begin to react a little bit. But we still think that they're abundant. And of course, now the TGA is emptying out, so reserves are higher now. So you can't really see the underlying signal. So we came around to the view, and it had a lot of appeal, and so we did it. It has no implications at all for monetary policy. It has no implications at all for the ultimate size of the balance sheet. It isn't sending a signal in any hidden way that you can try to tease out. It's just not there. We're basically, it's very consistent with our plans and our practices that we've published and that we've followed since we began this, what is a very successful rundown of the balance sheet. Again, the second time that we've slowed the pace, and we've said that we would stop when we were somewhat above the level we judge as ample. And clearly we're not at that level yet, but we're going to be approaching it more slowly. It's a common sense kind of a thing, and it had pretty broad appeal, I will say.
Claire Jones, Financial Times. You said in January, Chair Powell, that inflation expectations remained well anchored. Would you still say they remain well anchored today? And just to reiterate the question others have asked, if they're not so well anchored, why hasn't there been a more radical shift to the policy path today? Thank you.
So when we talk about inflation expectations being well anchored, we're talking about longer run inflation expectations. And they really haven't moved much. I mean, if at all. There's one reading that everyone's focusing on that it's higher, but the other survey readings and the market-based readings all show relatively, well-anchored inflation expectations. You would expect that expectations of inflation over the course of a year would move around because conditions change, and in this case, we have tariffs coming in. We don't know how big, what's big. There's so many things we don't know, but we kind of know there are going to be tariffs, and they tend to bring growth down. They tend to bring inflation up in the first instance. So I would say, I'm not dismissing what we're seeing in short-term inflation expectations. We, as I mentioned, follow that very carefully. But when we say expectations are well anchored, we're really looking at longer terms, 5-year and out, and there's really no story to tell 5 years and out, either in market-based or in surveys. But we'll watch it. I mean, we're not we're not going to miss any evidence that longer-term or medium-term inflation expectations are moving.
Hi, Chair Powell. Neil Irwin with Axios. Treasury Secretary Bessent has observed that a large share of job growth over the last couple of years has been in what he calls government or government-adjacent sectors, healthcare, education. Do you agree that there's some weakness in underlying private job growth, and do you see the composition of job growth as something that has policy implications?
So that has been the case. We talked about that over the course of the last year. There were some good number of months and times when a lot of the job creation was concentrated in, educational institutions, healthcare, state governments, things like that. There were also times when private sector job growth has been moving in a healthy range. I mean, they're all jobs, but and remember, we're at very low unemployment for quite a time now. So I think it's a good labor market, but it's something that we monitor carefully. From our standpoint, employment is employment. But the elected government is entitled to have, we don't have policies that address different kinds of employment, but the elected government has a different role, and they can have those.
Can I do a quick QT question? Does the committee envision at some point tapering the MBS runoff as well?
I think tapering it, I don't know. There's no plan to do that. At a certain point, we'll stop runoff. And we may or may not stop MBS runoff, though, because we want to stop runoff in net at some point. We haven't made any decisions about that. We want the MBS to roll off our balance sheet. We really strongly desire that. So, but we haven't made any decisions about that. I think we'd look carefully at letting that keep going, but hold the overall size of the balance sheet in, constant at some point, a point that we're not out yet.
Simon Rabinovich with The Economist. Thank you, Chair Powell. Several times today you've said that you feel you're well positioned to wait for greater clarity. At the same time, you could point to quite a few growth risks at the moment. We've seen a stock market that's gone quite wobbly, rapidly cooling housing sales, plunge in confidence surveys. Today, not only did the S&P mark down the growth outlook, 17 of 19 see risks to the downside. So my question is, how confident are you that you're well positioned, or is that one more thing that you're uncertain about?
I'm confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move. I don't know anyone who has a lot of confidence in their forecast. I mean, the point is we are at we're at a place where we can cut, or we can hold what is clearly a restrictive stance of policy. And that's what I mean. I think that's well positioned. Forecasting right now, forecasting is always very, very hard. And in the current situation, I just think uncertainty is remarkably high.
And sorry, standing here today, would you be surprised to pivot back towards rate cuts in May?
I think we're not going to be in any hurry to move. As I mentioned, I think we're well positioned to wait for further clarity and not in any hurry.
Matt Egan with CNN. Thank you, Chair Powell. The Fed statement released today removed the line that previously said the committee judges that the risks to achieving its employment and inflation goals are roughly in balance. Can you explain the decision to remove that line? Does it mean that you're now more concerned about inflation or about employment?
Actually, it does not mean either of those things. Sometimes with language, it lives its useful life, and then we take it off, and that was the case here. There's really not meant to be any signal here. Over the past year, conveying the sense of the balance of risks was important, that they be in balance or close to being in balance. That was useful as we approached liftoff, if you remember. But we're past that. Beginning to cut. So we just took it out. I actually would say that the more important thing now about risks, and this is in the pages like 10, 11, 12 of the SEP, if you look, participants widely raised their estimate of the risks to of uncertainty, but also of the risks to growth and our employment and inflation mandates. That's a more salient point now than whether they're in balance.
Just on the stock market, the stock market has obviously declined significantly since the Fed last met. Are you concerned at all about some of the market volatility having a real economic impact in terms of hurting business spending or consumer spending, especially among higher income households?
So financial conditions matter to us because, financial conditions are the main channel to the real economy through which our policy has its effects. So they're important. But what matters from a Fed standpoint for the macro economy is material changes to overall financial conditions that are persistent, that last for a while, long enough to actually affect economic activity. So that's what we're looking for. I'm not going to opine on the appropriate level of any market, equity, debt, commodities, or anything like that. And I would just point you to the bigger picture again. You know, the real economy, the hard data, are still in reasonably good shape. It's the soft data, it's the surveys that are showing, significant concerns, downside risks, and those kind of things. We don't dismiss that. We're watching it carefully, but, we don't want to get ahead of that. We want to focus on the hard data. If that's going to affect the hard data, we should know it very quickly, and of course we'll understand that. But you don't see that yet.
Jennifer. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you look to navigate higher inflation and lower growth, the Fed has talked about heeding the lessons from the 1970s. Is the Fed willing to have a recession if it means breaking the back of inflation?
Well, fortunately, we're in a situation where we have seen inflation move down from, higher levels to pretty close to 2%, while the unemployment rate has remained very consistent with full employment, 4.1%. So we now have inflation coming in from an exogenous source, but the underlying inflationary picture before that was, basically 2.5% inflation, I would say, and 2% growth and 4% unemployment. So that's what we did. That's what together the economy accomplished. So I don't see any reason to think that we're looking at a replay of the 70s or anything like that. Inflation, underlying inflation is still running in the twos, with probably a little bit of a pickup associated with tariffs. So I don't think we're facing, I wouldn't say we're in a situation that's remotely comparable to that.
And last month, the idea of a Doge dividend was proposed, which would send $5,000 checks to every taxpayer from Doge savings. President Trump and Elon Musk have supported this. There's reports there could be a bill introduced on Capitol Hill. What impact might that have on household savings and spending in terms of your growth and outlook for inflation?
It's not appropriate for me to speculate on political ideas or fiscal policy for that matter. So I'm gonna pass on that one. Thank you.
Daniel.
Hi, Chair Powell. Daniel Avis from Agence France Presse. You mentioned that tariffs are already having at least some impact on inflation. I'm just wondering how you and your colleagues on the FOMC have been thinking about the possibility of retaliatory tariffs from other countries, especially with April the 2nd coming up. Was it something you considered during this meeting? Thanks.
So since the very beginning, we've had kind of a placeholder. The staff has a placeholder of a range of possible outcomes from tariffs and from trade policy generally, and they generally assume full retaliation in those, and so that's kind of baked into the numbers. What happens? It will be complicated, and there will be some retaliation and some not, and all that. But ultimately, they're trying to, with the placeholder, give us a broad sense of what this might look like. When we actually know the specifics, we'll be able to have still uncertain but better informed forecasts. So yes, that's in there.
Last question goes to Jean.
Hi, Chair Powell. Jean Young with MNI Market News. Had a couple questions on the balance sheet change that you made. So the minutes had initially described your discussion on slowing QT as temporary until the debt ceiling is resolved. But from what you said earlier, it doesn't sound like there's a desire to kind of regain the pace of QT that we have at the moment after the debt ceiling is resolved. Is that the case?
Yeah, so we looked at pausing and we looked at slowing, and really people came together very strongly behind slowing, not pausing, for a variety of reasons. And so people really came to be, pretty strongly in favor of this move. It slows down the path and probably lengthens it, doubles it effectively by slowing by half. That people thought that's a good place to be. It'll help us assure that this path is a smooth one as we get closer and closer to that. So that's how that came about.
Well, I guess my question is more, was that meant to be a temporary measure during the debt ceiling episode, or?
It was the TGA flows, Treasury General Account flows, that got us thinking about this. But the more we thought about it, we came around to this. And you know, it is, yes, it was provoked. The original discussion was provoked by that. But I think what we came up with, though, was broader than that and different than that. It does address that issue, but it really is also, it fits in really nicely with our principles and our plans and the things we've done before and the things we said we would do. So that's why, you know, pretty strong support. I just say it's nothing to do with monetary policy, nothing to do with the size of the balance sheet. It's just kind of a common sense adjustment as you get closer and closer. Let's slow down a little bit again. And that way we'll be more and more confident that we're getting where we need to get. You can take our time getting there. You know, we're shrinking the balance sheet every month, and we think it was a good play, and as I mentioned, well supported. Thanks very much.
All right. Well, a few things. Should be a politician. I did a tariff counter, okay? How many times did Jerome Powell say the word tariff? I'll get to that here in a second. But a couple notes I have here. And then we'll take a look at how the market, you know what, actually first, let's take a look at how the markets reacted to that, to Jerome Powell. Let's go to the 15-minute on BTC. So this is when it started. It was 11:30 PST, and I'll drop a vertical line here. So to the right of this green, and I'll change the color here. Let's go there. Okay. So to the right of your pink vertical line is going to be during Jerome Powell's speech. And you see the markets actually rallied from open to the highest wick around 2%. I know that's not a massive move, but the markets didn't dump. And so I think that's what a lot of people were waiting on and expecting. Are the market's going to dump? And you can see even on the lower time frames, we had a little, what's he going to say? Nothing really. And then bam, right around 11:50 Pacific time. I think that's when he was talking about slowing the pace of the balance sheet runoff, where we had a couple of liquidation candles to the upside for BTC. And on the, let's get rid of the MA ribbon. Let's go to the 1 hour. Let's take a look here, and we can get rid of this. So just a lot of indecision, right? A lot of volatility. This was a 2% candle with a low of 83.6 and a high of 85.8. And so this is a $2,000 range, and this was a liquidation candle to the upside. And there's tons of volume coming in here as well. On this hourly candle, this was about an hour and 22 minutes ago. Now, some things that I have noted, I have written down for what Jerome Powell said. Said the labor market is in balance, not imbalance, but is in a balance. And so he's referring to the jobs numbers. Of course, he's referring to the unemployment rate. And so I guess you can say that was a positive. The other thing he talked about was 4.4% median unemployment rate being a good thing. Even though that number has gone up from last month, he's still saying it's good. He said inflation remains elevated, and tariffs are a driving factor. Now, my tariff counter says he used the word tariff 14 times. I have a little counter here. I did a counter. 14 times he said the word tariff. And so listening to the hour and a half long of Jerome Powell answering questions, what I took away, he's telling Trump, look, dude, it's going to be your fault if I keep the interest rates high. It's going to be your fault if inflation goes higher, and you kind of have our hands tied behind our backs. You want me to cut rates? You want me to, spur the economy? Tariffs. So that's what I got out of it. I'm curious to know what you guys got out of listening to Jerome Powell bring up the word tariff multiple times, specifically 14 times in total. That's kind of what I got away from it. I'm curious to see what you guys thought. He talked about 2.2% PC in 2026. That is their expectations. And then in 2027, that number dropping to 2%. He puts the rate cuts on Trump, said policy changes at the White House. I wrote that down as a note. Multiple times pretty much said there's no need to hurry. yeah, no need to hurry. We'll wait for more data. We'll see what happens. And so, I don't know. I thought the markets would dump on that, but I guess they didn't. And then the projections are as follows: 50 basis points this year and another 50 next year. What I think from listening to him and what I think is going to happen is that either something needs to break, we need to get some shocking number, or as he mentioned, long tail, or the word he used was persistent. The material changes need to be persistent. If unemployment rate's going to go up, 2-3 readings won't be enough. It needs to be persistent. The GDP numbers come out at -2%, 1 quarter, 2 quarter. It won't matter. It needs to be persistent. Well, technically, after 2 quarters, you'd be in a recession from a technical kind of jargon standpoint. They're going to slow the pace of balance sheet runoff. Some signs of increased tightness. He did throw that in there as well. They're focused on their employment goal at this meeting. He talked about the little summit they're doing in June, or their summit they're doing, and then they're going to have a recap in June. It was brought up the fact that, hey, look, a lot of the jobs were added last 2 years was public sector, education, healthcare. And so with that being said, and what we're seeing with Doge, I think those unemployment rate numbers are going to continue to go up. Says inflation is moving up due to tariffs. And again, this is what leads me to believe that he is pointing the finger right at Trump and saying, this is on you. You want me to cut rates? Stop with the tariffs. I said tariffs bring down growth and bring up inflation. That would be what's called stagflation, my friends. That's in the 70s what happened, and they hiked the interest rates up 20%. High uncertainty. He was asked about a recession. He says, now the probability is always 1 in 4, so 25%. But interestingly, he said the possibility has moved up just a little bit over the last few months. I thought the markets were going to dump on that. Obviously, we didn't see that. And then he was asked about cuts in May. Again, he said, we're not in a hurry. They're kind of, and again, you look at historically what the Fed does. They are reactive, not proactive. If they were proactive, we probably wouldn't have seen inflation like we saw in 2022. They would have figured out, hey, people have been getting money. They haven't been able to spend it. Now, once the floodgates open, it's going to push consumer prices up. As supply will still have an issue because of the supply chain and the shutdown, but demand is going to be at all-time highs. And so projecting that would have allowed them to raise interest rates a lot sooner and at a slower pace versus coming in there and saying, oh my God, everything's broken. Let's hike it 75% or 75 basis points, shock the market. And then that's what happened. So either we need to see some sort of indicator, numbers, report that is a shock to the Fed, like a B-12 shot in the rear end to be like, all right, you need to get this thing moving. Or you just need like 6 months of just freaking, I don't know, crappy numbers, the stock market declining. And then last thing he said was concern with the stock market. He said the financial conditions matter. And again, they're looking at persistent changes. Let's get rid of this note here. So those are my notes I took. Curious to get your guys' thoughts. Obviously, QE or QE specifically, but also cutting interest rates is what we need, right? And so the Fed's going in the right direction. 50 basis points this year, 50 basis points next year. But again, as Mike Tyson says, everyone has a plan until they get punched in the face. And the last time the Fed got punched in the face, they went from 0 to 5.5% in a matter of months. That is a massive shock to the markets. Could we see something similar to the downside if we do get numbers, but the opposite, where the economy shows slowing down, where unemployment rate's going up, inflation is cratering, and maybe we see what's happening in China with deflation? Does that come to the United States? I don't know, but that would be a spur. And so H. Barbine said, are we still on path to alt season? Yeah. I don't think the bull market is over. We're just in this weird macro spot. We also had some people are expecting Donald Trump, apparently, and I saw this from multiple sources on social media. This is posted by Max Brown BTC on X. Trump will make a major announcement on Bitcoin and crypto today. I don't know what that is. If you guys have any insight, please let me know. But let's just refresh this page, see if we got anything updated here. Nothing yet. And so we'll see how that plays out. What the announcement is, what can we expect? And let's go back to CoinMarketCap and take a look at the rest of the markets. I do have a couple pieces of news I do want to share. We'll get into that as well. XRP kind of still hovering around at $2.50 level. Again, big news today as they announced that the SEC has officially dropped their appeal. We did a video on that earlier this morning, so it's posted on our YouTube channel. Make sure to go watch that video, kind of breaking down what happened, what was said, and what it means for XRP moving forward with now that the appeal is done and essentially the lawsuit's over. Something we've been talking about for a very, very long time. Solana is seeing a decent rally, 6.5% on the 24-hour. Even Tether is up. Just kidding, of course. Doge, Cardano. Cardano is in an interesting spot here, 72 cents. Let's take a look at an ADA chart. Also, by the way, guys, big shout out to Poman. I believe Poman gifted 5 memberships. So thank you, Poman. Appreciate you, my friend. All right, so Cardano chart, as I was mentioning, this is ADA on the 1 hour. This trend line here that I have on here for ADA, and I think I had this thing on. Yeah, so we had some confluence for our POC and a key. I think this was a key volume level here. Yes, it was right around 81.5 cents. Cardano is testing this upper end of this trend line, which is currently sitting at around 75.1 cents. It did attempt a reclaim and a break above, but it ultimately failed, spilled off. But we could be coming into potentially a bull flag pattern. You guys know how much I love my bull flags, my favorite. And then on the larger time frame, on the daily for ADA, let's take a look at what we're seeing here. Let's get rid of this. Big high volume note at 57 cents, around 10.5 billion ADA was accumulated. But you can see here, and I'll remove this, we've given up. There's just no like follow through, right? We've given up almost 100% of this move Cardano saw from 62 cents to $1.17. And this was going back to the beginning of March. Cardano had that massive rally off the news of them being included in the crypto strategic reserve. And we've given all of that back, and it's chopping here. It's chopping here right below our 786 Fibonacci level. And again, kind of creating this area. You know what? Let's throw on. Let's hide that sucker there. I want to see what this range looks like. Let's look at this range from here to here. So we're right at our POC, and the range that we're looking at is from the beginning of February until now. And so you're seeing massive amounts of volume. Now you do have your fair value area here between around 63.5 to around 87 cents. And we also have some confluence on some support and resistance levels. But 67.59 cents seems to be a very good area if you're looking for a swing trade, if you're looking to enter into a long, or if you're looking to add to your spot bag. 67.5 cents is an important region for Cardano. But again, you see volume has essentially fallen off a cliff from its high we saw back on the 2nd of March, which again was that big move off of the news of the strategic reserve and Cardano being included. Now with the futures for Solana going into play, I think that's a signal to the markets that ETFs are coming. I think Cardano is going to get an ETF. Obviously, there's the application has been in, but at the end of the day, nothing's set in stone until it's signed, until it's actually trading on the market. If it's a spot, trading on the stock market. If it's a futures, is it trading on the CME? And so that's as far as Cardano goes. I did want to highlight Hedera. I know we got a lot of Hedera fans in here. This was State of Hedera Q4. This was put out by Masari, which they do really good in-depth research. Some of their key insights here, okay? This is for Q4 of 2024. Their market cap increased 375% quarter over quarter. And what I want to do is I want to go back and forth between that and the H-bar chart. This is H-bar on the daily. Let's zoom in to maybe the 2 hour and take a look at Hedera. Now, this was a symmetrical triangle, or you can, this wasn't really a bear flag. This was a symmetrical triangle that broke to the downside, and we're kind of chopping. And if I extend this trend line here, and we extend this trend line here, right? So this one will hide this one. So we broke out of our symmetrical triangle, and we obviously got pushed to the downside. Now, those symmetrical triangles are usually 50-50. But this one, we broke below, came back, failed on the retest twice. And I wish this drop was a little lower. This would be a really nice setup for an inverse head and shoulders. But technically if we're splitting hairs here, technically you have a potential inverse head and shoulders as this line. And I will make this line thinner. Wish I can do that to myself, make myself a little thinner. So this is the line that the price closed. This would be the head of this pattern. And the shoulder, the lowest close we had on that shoulder was around 18.3 cents. And the lowest we had of our head is around 18.26 cents. Again, this is splitting hairs, but this could be a nice setup for a break to the upside. I am looking at, for H-bar, price action-wise on the lower time frames, I'm looking at this 19.7, let's just call it 20 cents. 20 cents. And Hedera has been one of the strongest altcoin charts, period, in the entire space. We throw on our range here. Let's see where our POC is, where a lot of volume has traded. You can see price has consolidated and flipped this POC multiple times from support to resistance. You can see here, this held as key levels of support for the most part. We did get some closes below this level, but ultimately, the very next 2-hour candle, we came right back up. We had our breakthrough, attempted to retest on a wick. Again, consolidation. So this, and I'll drop a horizontal line so this thing extends out. So the key level here that we want to break and take is going to be 19.26 cents. If we can get above that level, the next stop you're looking really at, you have that 20 cent. That is your upper area for your fair value for H-bar. Going back to this, though, DEX volume on Hedera hit all-time highs in Q4 of last year. 10.7 million per day, a 530% quarter-over-quarter increase in average daily DEX volumes. It briefly mentions Karate Combat, which, by the way, love Karate Combat. Shout out to those guys. If you've never been to a Karate Combat event, highly recommend it. It's a lot of fun. Bonzo Finance launched at the end of October and closed Q4 with 25 million in TVL. And their stablecoin, this is an important one for me, for Hedera, is stablecoin. That market cap increased 272% quarter over quarter. Stable coins is going to be an absolutely massive narrative. And you take a look at this article here from Cointelegraph. Congress on track for stablecoin market structure bills by August. United States lawmakers are on track to pass legislation setting rules for stablecoins and cryptocurrency market structure by as soon as August, which CEO of Blockchain Association, Kristen Smith, has said during the Digital Asset Summit in New York this year. She said, quote, "I think we're close to being able to get those done for August." Now, remember, August is when Congress goes for recess. Is it before or after? Someone correct me. Do they go to recess before August or after August? I think it's before, but I could be wrong. Or after, but I could be wrong. I think we're close to being able to get these done. They're doing a lot of work behind the scenes right now. I'm optimistic when you have the chairs of the relevant committees in the House and Senate that want to do something, and you've got bipartisan votes in Congress to get it there. This would be the very first step, and we all know, we talk about liquidity in markets. The lifeblood of liquidity in crypto is stable coins. And if we get a stable coin bill and the stable coin market caps grow and we get other issuers in here, what we see is a diversification of potential risk factors. So whereas Tether has, let's just say, 80% of market share, that is obviously a potential hindrance. That is something that could potentially go wrong there that can bring the entire industry down in the short term. You want more players. You want more stability. You want this thing to be diversified. And I think that's going to help with it as well. And I've talked about this multiple times on the morning show. Stablecoin plays are the way to go now, among other things. When you talk about projects like Athena, Athena has been absolutely brutalized. I was able to bring my my cost basis down a significant amount because I was buying sub 40 cents. Not a large amount, but let's just pull up an ENA chart here. But ENA is a big play for me. It's backed, again, as you saw, backed by Arthur Hayes, which is a pretty big name in our space. Funding rates were absolutely atrocious. I mean, they were like negative 300% on the funding rates for Athena, and it had this massive drawdown. I mean, this thing gave up everything it took, literally, from that move back in from November of last year. It gave it all back, not plus some, but it gave it everything minus 2%. It gave it all back. Now, the big issue here with Athena is going to be their token unlocks. There's a massive amount of tokens that are being unlocked, and we can actually check that. In relation to their market cap, it's fairly high, but those matter less in large bull markets when you see parabolic price action versus in bear markets when things like that are more amplified. And so my basis is we're still in a bull market. I think we haven't even seen that parabolic run up, but you can see here 2%. This is on April 2nd. You have around 2% of the market cap being unlocked and then 3.26. So they alternate between 1.26 or 1.78 and 3.26. But I think they just had a big one. This was the big one here. Guys, this was 40% of their market cap was released in the form of tokens, and all of it went to core contributors and investors. And looking at price action, and when did that happen? That happened March 5th, so 14 days ago. And March 5th is looking like we actually had a little bit of a drawdown on March 5th, and this is the candle I'm looking at. I always like to look at token unlocks and how the price reacts to see what we can expect in the future for future unlocks. And this is the candle you're looking at here. The red candle within there, that was actually a 10% candle to the downside. And then we actually saw a nice rally out of Athena from its close to wick high of around 40%, and it's kind of been trending down. If we zoom out to the hourly, let's take a look at where our traders and buyers stepping in. Also, one thing to keep in note here, this is actually a bearish sign, is you have this rising channel, which we saw from other ones. They do tend to break to the downside. Now, a test of the lower end here is going to be right around 36 cents, and your measured move, if it fulfills, we take the width of our channel, and that measured move would bring us to the low 30s, specifically 33.45 cents. For me, Athena is a long-term play. It's got big names backing it. It's got amazing utility. And again, with what we're going to see from Congress with stablecoin legislation, you'd be stupid not to have, if it's not Athena, something, convex, curve, asymmetry finance. You have a bunch of other ones that could make you, MakerDAO is a good one. I think MakerDAO actually had a really nice rally. Let's take a look at MakerDAO. MakerDAO. Let's go to the daily on MakerDAO and look at the daily. MakerDAO over the last, when we got a bottom here, and by the way, these boxes here, these have been value areas that we've identified on our trading show that we've been doing Monday through Saturday at 2 p.m. Pacific, 5 p.m. Eastern. These have been levels that we've identified on higher time frames, and just look how perfectly we're coming back and tapping these on wicks. And so this level, $1,000 and $1,014 is a pivotal level for MakerDAO. We've had 3 wicks down to that region, and from wick to wick, we saw a gain of around 30%. And but the setup here for me is actually pretty bearish. As you can see here, we are seeing a potential bear flag pattern play out here, and then this thing will break to the downside. Now, the first level, you want to talk about trades, the first level, I would be extremely happy to enter into a 10 to 15x long position on MakerDAO at around $1,054. You can set another limit order right at $1,000 even. and 886, which we reached back in February. I don't see it getting that low, especially again with everything happening with the stablecoin market, the stablecoin bill passing. So a lot of money to be made in that sector. There's a lot of money to be made in RWA. There's a lot of money to be made in AI still. You look at projects like Virtuals Protocol. You look at projects like Hollow World. You look at projects like Eternal AI, AI XPT, some of the higher risk, higher reward plays. These are amazing opportunities because once AI, that narrative gets going again, and with a sector like AI where you constantly have new news and breakthroughs coming out, the hype will always be there. It'll always be in the headlines. And you just got to figure out how does that translate to me making money in the crypto space. With that being said, I just want to take a peek at the chat. I know we turned the stream from covering Jerome Powell to some charts and analytics, which is usually separated from our morning and our afternoon show. But you guys get a little taste of what we do on the afternoon streams. So if you enjoy the content, we look at technical and fundamental analysis, please come join me. Now, today we're not going to do it because this is ended up being a 2-hour live stream where we did both shows essentially back to back. But starting again tomorrow, 5 p.m. Eastern time on this channel, we'll be looking at fundamental and technical analysis. And then we do Sundays, Saturdays as well. And then Sundays, we are doing I do kind of like a crypto and chill show. Engaging with the community, Q&A, nothing planned, just kind of vibing with you guys, talking about my thoughts, markets, what happened the previous week, and what to expect in the week moving forward. And so those are some things I'm looking at. But I'm telling you guys, my 3 narratives, and I really want to say 4, stablecoin, AI, RWA, and a honorable mention is gaming. And I think with GTA 6 coming out, that gaming narrative is going to blow up. Also, speaking of gaming, I was playing Fortnite with my kids the other day. So I found out that the new Fortnite, the new Fortnite theme is crypto scams, and they have a gun called the pump and dump, bro. I was dying. It was so funny. All right, let's take one more peek at BTC. Let's take a look at how Bitcoin is doing. We'll go to the super low time frames. 85.3. Not bad. Not bad, BTC. Okay. Fake out breakout. Again, invalidation means 86.5 and above for me. Let's go to the 10-minute time frame here on BTC. Actually, since we're in Vegas, that's the whole reason I created the 21-minute and the 21-hour time frame. Blackjack, Vegas, gambling. Nice double bottom with a V-shaped recovery to the upside. We came back and retested the bottom end of this trend here. Let's take a look at our price action concepts here from LuxAlgo. See what kind of gaps we created. See if we saw any change of structure in the chart. So we did create a gap on the way up, and it looks like that gap, at least to the midline, has filled. To completely fill this gap, you're looking at a retest of 84.8. We had a large liquidity grab right around 84.8 or 84.9 that pushed the price up to a wick high of, let's call it $86,000. And if I go back to the higher time frame, guys, the purple and the salmon line. Salmon's a pretty cool color, right? This area within this box here right now is the most important area, period. What I want to see, right? You want to talk about changing, because right now, price action wise, short term, I am bearish. I am bearish short term price action. You want to see me flip to bullish? You want to see me act like Rob on the show? Get into this range, okay? And I'll expand this. Get into this range. Come in here, reject off here, come back, retest 86, spend some time bouncing around. Let's see volume tick up. Let's see the RSI make a higher low. And then a breakout to around $87,800 to $88,000. Come back. Give me a retest, please. Give me a retest. And then I swear to you, I will do a special live show where all I wear is green. We'll have green behind me. And then my thesis will be changed to bullish on the short-term trend. I'm talking about trading trends, price action trends. I'm not talking about my long-term outlook. Very bullish on Bitcoin. Really, no matter what the price is, as long as the fundamentals have not changed. And so short-term, I'd be looking for shorts at key resistance levels. That is how I've been making my money. We did make some money on an XLM trade that actually got filled on a wick. We sold at like 28.7 cents, I believe. For XLM, I made some money on my personal stuff, and this was again, this is what you want to see, man. This is what you want to see. And we go to the 12-hour. And let's go here. And I'm just going to make this visible on the... Let's go to 24-hour. Beautiful. That's that. That way we can see this thing on the 12-hour time frame. Bam, 12-hour. There we are. Okay, so this was essentially a falling wedge pattern that we saw from XLM. Let me kind of clean this chart up here a little bit for you guys. Outside of this deviation, we've just been bumping up against the top end of this. And then once this was on the 13th of March, you see that range start to get tightened. And we started to retest that 25.88 level. And that is a level, that is a price that I had a limit order on XLM, and it ended up being the perfect bounce. And from that level, we have bounced 15%. Not bad, making 15% gains in a crappy market going to the downside. This was one of the very few, if not the only ones I was willing to go long on. We did also have this really nice inverse head and shoulders pattern. We had volume start to tick up. RSI was showing bullish divergence. We were seeing how price was reacting at this level, and we ended up getting a break above. And on the 4-hour, I believe, we ended up getting a break above and not necessarily a clean retest. But yeah, I mean, I'm super bullish on XLM. The only thing that would invalidate this is just the overall macro. If an announcement comes, the markets overreact, tariffs, then obviously this can be invalidated. We can come right back into this pattern. First test that 25.88 cent region, then go in and test the lower end of our trend line here, the bottom end of our falling wedge, which would be anywhere between 23 to 22 cents. And then if we break that, like Magic said on the show yesterday, you're looking at like 10 to 13 cents for XLM. I don't think that's the base case. XLM has been one of the few altcoins that has consistently traded above its 200-day moving average on the high and the low time frames. So bullish on XLM in the short term. I'm also very bullish on all of you here. Make sure you are subscribed to the channel. We put out a crap load of content here. Whether the price is up, whether the price is down, you will always get all the up-to-date news here. So shout out to all of you. Again, big thank you to Poman for gifting 5 memberships. Let me just take a peek and see if we had... All right, RustyBot gave 20 Nokia phones. Said we don't joke about volatile stablecoins, David. Yeah, UST. No bueno, my friend. And then Poman gifted another 5 memberships, so 10 total. Thank you very much, Poman. I appreciate you, brother. All right, guys. Brokioshi, you're funny. I want to thank you all so much for watching. I hope you got some valuable information out of this. Now that the FOMC is over, markets are going to reset. Now it's going to be, the next big date is going to be April 2nd. What happens from now until April 2nd? That is when the retaliatory tariffs are going to go into place. We know Trump met with Putin yesterday, or they spoke on the phone. Everything going on. And I want to just remind everyone, the sentiment is bearish. Price action, bearish. Everyone, bearish. Portfolios are down. But I'm telling you, one announcement, one move, one change can literally disregard every single feeling you're feeling, every single indicator, every single chart, every single trend line, every single everything. One announcement, one big piece of news, it could change everything. So keep that in mind. Now is not the time to panic. Now is not the time to sell. Now is the time, when markets have been boring, to figure out what is undervalued and what's going to allow me to put 10 grand into a project and turn it into 100. Into 200, into $500,000, or what to take $500 and turn it into my entire year's worth of rent or mortgage payment. That is very powerful, and that, in my opinion, can only exist in the cryptocurrency space. So if you have questions or doubts whether you're in the right space or not, it's not perfect, but it's the best space to change your life. I love you guys. I'll see you tomorrow. Peace.